Welcome back to the Investing Markets and Money podcast from the Armchair Trader. This is editor Stuart Fieldhouse joining you again, and we are talking investment trusts this week. Joining us on the podcast is Ryan Lightfoot-Aminoff from Kepler, which is a specialist in the area of investment trusts. He is an investment trust research strategist, and we're going to be talking about some of the hot topics in the investment trust universe this summer. Welcome to the podcast, Ryan.
Thank you for having me.
Very quickly, some people will be familiar with Kepler, but just very quickly, can you give us a quick summary of Kepler and what you guys do there?
Yes, of course. So we are a research house. So we specialize, especially on the KTI side, so Kepler Trust Intelligence side, on investment trusts. And we try and cover as much of the market as possible to give investors, all the way from professional to retail, updates and information about what investment trusts are doing. We'll have profiles on our website, which is free to access, that will go through a trust's performance, its positioning, and then how they're using things such as gearing, which is where they can borrow more to enhance the returns, and what sort of discount they're trading at as well, to give investors as much information as possible about the investment trust world.
Also, very quickly, some people won't be familiar with what an investment trust discount is. I know we're going to be talking about that later, but can you just give us a quick definition on that?
Of course. So the investment trust is quite unique in a structure that it will have a NAV, a net asset value, which is the total of all of the investments that it holds underneath. But then it will trade as well. So it has a share price that can move up and down depending on sentiment and a number of other factors. And if this share price is below the trust NAV, so say all the assets sum up together to be 100 pence per share, but the shares are trading at 90 pence per share, you're at a 10% discount. So you can effectively buy that portfolio for 10% less than what it's actually worth.
And I wanted to start off really talking about the US market. That's something that a lot of people are very interested in at the moment. Obviously, there's going to be an election coming up in November, and it seems as if the market is placing more emphasis on that, and that's going to be the news flow from that election is going to be feeding through into US equities and more generally global equities. From your perspective, what are your thoughts about that and the volatility that might be creating in the US market, and what should investors be thinking about right now?
Yeah, well, we've looked at some of the numbers as to what's happened in markets when elections have happened, and sort of in the last 24 election years, the S&P has actually risen in 20 of them, with an average total return of around 11 to 12%. This is actually higher than the long-term annualized return of the index, which is around 8%. So historically, elections have not really been a major drag to performance returns. However, as we know, past performance is no guarantee of future returns. And I think that with any election scenario, particularly the US, in a very unique election we've got right now, it's really important to separate sort of the history, the person, and the politics. So if we strip away the labels of who's going in and look to the parties, it's typical that Republicans are more pro-business. So that would be a better outcome for maybe company earnings and probably markets. This has been the case historically. So in the years that a Republican candidate has won, average returns for the S&P that year have been around 15% versus Democrat victories of around 8%. So even though Democrats are typically less of a positive impact on markets, it's still in line with an average year for the market. And now looking at the potential policies that they might have, Trump's previous administration focused around tax cuts for businesses, which bringing overseas earnings back to the US has benefited the likes of Apple, whereas the Democrats focused on their big win was really the CHIPS Act, which lent a lot of support to the tech sector and boosted a lot of companies there. Both sides actually agree on one thing, and that is they're very similar views on China and the fact they're both quite negative on China. So lots of the policies we expect to come out, expect to be announced, are probably to support US tech and then crush the Chinese rivals. So while that would be positive for US tech and the Magnificent Seven, there is the one wild card thrown in of Trump's very personal views on certain companies. I think earlier this year, he declared Meta, who are the parent of Facebook, an enemy of the people, which from a stock specific level does add a certain amount of concern. So we think the best thing to do is look at diversification. It's about the only free lunch you're going to get investing. So utilizing this could be a really good way of balancing a portfolio.
And talking about diversification, you've already mentioned the magic words "Magnificent Seven" stocks. These are the big tech stocks in the US that continue to trade higher in many cases and attract a lot of interest from investors. We've been hearing a lot from analysts recently about unprecedented levels of concentration risk, meaning just the market as a whole taking on massive exposure to just relatively small number of companies in the overall index. Is that something that people should be worried about? And are you seeing that concentration risk appearing within the portfolios of the investment trusts that invest in US equities?
I don't think we're seeing it in the investment trust universe. It certainly does add a risk, not just because it is just 7 companies, but a lot of them are very tied into very similar themes of that tech boom. And also they are very, what we call growth companies, as opposed to value companies, where you're paying for the future earnings of the company rather than doing on a sort of, this is what the company is worth right now and this is what its intrinsic value is. So there is a risk there. I think that does mean that there are actually a number of opportunities elsewhere in the market. So the Russell 2000, for example, which is the US's small company index, had a really interesting July. It had one of its largest rises ever, one-day rises ever, which has unwound a bit since. But it goes to show that there is an appetite for smaller companies when investors become more confident, and they have been ignored a lot over the past few years. So when the market does get excited about improving conditions such as rate cuts, the small cap index did move. It went up over sort of 11 or 12% in just a few days. Therefore, if the positivity returns to the market outside the big 7, we do think there's a big opportunity for some catch up to come here. One way to play this, especially in investment trust world, is Brown Advisory US smaller companies. The manager is a chap called Chris Berrier. He tries to offer core exposure to the market. So it's a more risk controlled approach, which in an asset class that is typically considered higher risk, and many people are concerned over the US and where they are in the cycle, it could be a more sort of risk controlled way of getting in access to it. Because of the weaker sentiment to market caps, though, the whole North American small cap sector is trading at a discount where the shares are worth less than their net asset value. This means that investors can buy the shares of BASC for less than the value of its portfolio, and that could add to returns if that sentiment changes and that discount closes, on top of the potential capital gains you get from the asset class.
And aside from diversification, when we're talking about potential volatility in US equities, is there any other ways to manage it rather than just diversifying? I mean, does it make sense, for example, to look at investment trusts that invest in, say, US government bonds or dollar-denominated bonds, for example, or as you said, small caps at the moment underpriced. Maybe that's an area that might do better in a higher volatility scenario.
Potentially, yeah. I mean, it depends in which direction that volatility goes. I think maybe to hedge the exposure specifically of the US, you can go one of 2 directions. Either you can take completely different exposure, or you can find a vehicle that actively looks to provide correlation to markets. So bonds is one example. We have other examples as well. But going back to the example of different exposure, there's a trust called Fidelity Asian Values. And the manager here has taken an actual anti-tech positioning. He believes valuations are far too high across the board. They're all trading on momentum rather than quality. And as such, he has only about 3% of his whole portfolio in tech companies. And that's compared to about 20% for his benchmark. He also has very low allocations to countries such as Taiwan, which is a major tech economy and has huge tech companies like the semiconductor company that makes all the chips that everybody else uses. Instead, he's focused on the domestic consumption story in the Asian region, and that has very little connection to the US elections. I'm sure if you go down to somewhere like Vietnam and ask them what they thought of the US elections, they wouldn't have much of an input on what the Magnificent Seven is going to do, and their lives are not really going to be affected by that. And therefore, that is one trust that could offer a good hedge to US equities. The other one is a trust called BH Macro. The trust is effectively a way to access the Brevin Howard Master Fund, which is a quite well-known and highly respected macro hedge fund. They have a variety of tools and asset classes, primarily focused on global fixed income, you mentioned, and FX, so currency, to try and create attractive returns regardless of market conditions, so ignoring the volatility. As a result, the trust has very low correlation to the wider market. They do this with a multi-team approach, so the strategy is not reliant on any one star manager or sort of betting the house on any market direction. And historically, this has done really well. It's delivered some excellent returns. In the 17 years that the trust has been running, it's delivered positive returns in 14 of them, and its best performance comes in times of market stress. So 2022, as an example, market really struggled, saw inflation coming in. The trust NAV for Brevin Howard was up over 21%. It's not often these sort of hedge funds are available to investors, especially retail investors. Therefore, BH Macro Investment Trust could really be a useful tool for investors concerned about the upcoming challenges and a good hedge for a portfolio.
Oh, that's very interesting indeed. I know we've mentioned discount opportunities earlier on the podcast, and I want to talk a bit about discounts now. We have been seeing, and I mean, the way I like to refer to discounts, and you'll probably disagree with me here, but it's almost like this investment trust is selling at more of a bargain price than some other investment trust. So it's currently cheaper than it should be. From your perspective, how would you evaluate a good cheap opportunity, i.e., an investment trust that is a good bargain right now, versus, say, an investment trust trading on a discount because there's a good reason it's cheap and you shouldn't really get into it in the first place?
Yeah, it's a great question and one that we sort of bandy around a lot in the office. I think context is usually key. So in our notes, we always put a 5-year history, if one's available, of a discount to see how the current level compares to the long-term average, also to its peer groups, and under what conditions that discount has changed. So taking an example of UK smaller companies, it's quite wide, the sector. The sector is quite a wide discount at the moment, has been for a number of years, since around 2016, reasons of which we won't go into. But many of those trusts, their discounts narrowed quite sharply at the end of 2019 after we had that election result where it was all about get Brexit done, etc. So it could be inferred that political concerns are having a big impact on UK small cap discounts. And potentially that could be sort of turning a corner at the moment. We have had an election. I'm sure many of the listeners are fully aware of that. So that could be something that starts to have a positive impact on the discounts of the UK small cap sector. Similarly, we've seen a lot of weakness in the renewable energy infrastructure sector. So solar panels and wind farms, in essence. These had a big expansion over the past decade. They were trading at premiums, so the share price was above what their net asset value was for much of that period. But these have gone to a big discount soon after inflation kicked off and the interest rates went higher. So investors have preferred to take access to lower risk assets such as government bonds, which now offer higher yields. And the renewable infrastructure sector is trading at some of the lowest aggregate discounts levels it has since inception. Again, we're arguably turning the corner on interest rates. We finally had an interest rate cut. So this would be positive for the renewable energy infrastructure sector, but discounts haven't really moved too much. You're still able to buy a number of really great trusts on good discounts.
And can you just give me some examples of, and not, you don't have to mention the names of any specific investment trusts, but what kind of things would cause an investment trust to be trading at a substantial discount with good reason, rather than just that market is looking undervalued at the moment?
That's a very good question. I mean, we can see that where some of the discounts are widest and have been sustainably wider is in Asia, where investors are particularly concerned over China, which does come with good reason. There's an economic slowdown. I mean, the country is growing, but at a much slower rate than it has done previously. And there are obvious questions over the government's approach and whether they want to sort of come closer or further away from the international sort of consensus. So that's an area where discounts are wide, and it's kind of easy to put an answer as to why. I think if you're looking at areas that could be maybe due a wide and a due a bounce, it's often good to look at sort of macro indicators. So we talked about interest rates earlier, and then smaller companies in that instance is probably one of the ones that looks most out there. So they've been out of favour for a while because of concerns over a slowdown. It's understandable. Smaller companies tend to suffer more in economic slowdowns. They have a more narrow customer base. They don't have a diversification of their business lines that multinationals do. And they often have higher financing costs as well. Sure, any small business owner knows that they're not going to get the same rate from a bank a large multinational will. So in the environment we're in currently with quite high interest rates, smaller companies are at a discount and are out of favour. But again, I think we're arguably seeing that start to change in the sector. Many of the sectors, so US and UK, are still trading on a discount, even though arguably we've turned a corner on their difficult environment.
I also wanted to ask you about consolidation within the investment trust sector, where trusts are being merged with other trusts. What is causing that? Why would people merge trusts together? And what does that mean for investors when that kind of process, you're invested in an investment trust and then you're told, hey, we're going to be merging with someone else? What does that mean for them as well?
Yeah, I think sort of the major driver behind it has been the market weakness. We have seen quite a lot of consolidation over the last couple of years. Um, and the weakness has pushed trust to discounts, which we've come back to again. So going back to really basic economics, share prices are just a function of supply and demand. So as interest rates have gone higher, it's reduced demand for equities because people can get better, well, good returns in the bank rather than the equity markets. This has pushed down share prices, which has a knock-on effect on investment trusts. Now, these discounts have consequences. So, as investors, like we use the example we used at the top of holding something in your portfolio at £90 is actually worth 100. You could, as a shareholder of that company, go to them and be like, right, wrap it up, give me the 100. I want that gain. So, the boards have been of investment trusts have been encouraged to try and avert this by looking at consolidation. So if they can merge with a bigger partner, the trust looks more attractive, and therefore it could bring those discounts in. It's actually quite a good demonstration of the perks of investment trusts. It's quite a capitalist approach of going, well, investors could ask for their money back at any time. So they've been looking at ways of making the discounts narrower through all the tools they've got at their disposal. So lots of underperforming or subscale trusts have been merging together or actually just closing up, and that has improved returns for shareholders. So while other investment vehicles such as open-ended funds could limp on with years of underperformance, the boards of investment trusts have shown they're on the side of investors and have acted accordingly to try and narrow their discounts.
Do they sometimes find themselves subject to investor pressure to do this? I'm thinking, for example, if there are larger institutional investors in the trust who can jump up and down, make a fuss, and say you've got to do something about this, and force them into that kind of a move.
Yeah, absolutely. There are some big shareholders that have encouraged boards just to wind up the trust, especially in some of the asset classes where the outlook for recovery is quite long into the future. Some of the equity market trusts, obviously, it's like the longest time from peak to trough to peak again is only a couple of years. You can see that recovery, whereas some asset classes, thinking of some of the more real assets, so buildings and infrastructure, where you've gone, well, it's been written, it's down this amount. Is it really going to come back by 50 or 60% in the next 2 or 3 years? So there has been some pressure there from investors. And then also we've seen an interesting move of some activist investors in the likes of Elliott, who are a very well-known US house, coming into the market to one of the biggest investment trusts in the sector called Scottish Mortgage, run by Bailey Gifford. They own big chunks of Tesla and SpaceX. And they've come in, bought a large number of shares, obviously have had a word with Bailey Gifford, we think, because there's some announcements have come out. The share price has reacted to that, and then they've sold their positions. So It's been an interesting period. Investment trusts. It's not often you see activist investors coming after it, but that is, we think, one of the perks of the asset classes. You've actually got that now, so you know what it's actually worth, you know what it's trading at, and it's one extra tool in the investor toolkit to be like, well, I can buy that at 10%, 15% lower than it's actually worth and wait for the recovery if I think it's going to come in this amount of time.
And I talk to fund managers on a regular basis, and I know some of them are quite keen on the idea of having an investment trust. And I know of one case, again, I'm not mentioning any names, but where they tried to launch their own investment trust. The IPO wasn't successful. They didn't get enough interest or traction in the market. So then they acquired an investment trust, and which they are now managing successfully themselves. From the perspective of those guys, why is it easier to actually go and buy yourself an investment trust that's already trading rather than launch a new one yourself?
Well, if you've got, at the moment, the market has been quite weak. So there's lots of things at a discount. So if you are coming as a new trust to try and launch, you're going to launch at NAV because that's what it is. Maybe less costs, but you're effectively launching at NAV. If there are lots of trusts available in the market at wide discounts, especially in some areas like real estate, you as an investor could be like, well, I could buy something worth 100 and pay 98p for it at launch, and then suffer all the costs, wait for it to be sort of rolled out, the money to be distributed into those assets. Or I can buy something that's established, been running for a long time, and it's priced at, well, the value is 100 and it's trading at 40 or 50 or 60. Well, if I look on 3 years' time and both of them return 10% and then sentiment changes on one, you've got all that extra benefit from the discount closing to actually go out and add to your returns. So more than just the underlying performance of the portfolio, you've got that discount narrowing effect to come in as well. So when the market is weak and trusts are trading at a discount, it's very difficult to launch new vehicles. And like you said, we have seen a couple of examples of people going out and just taking over other investment trusts.
Finally, I wanted to ask you a little about ETFs, because obviously at the moment in the European market, the vast majority of ETFs are very much passive index tracking listed funds, but they are listed funds. What we're starting to see in the US is the advent of the active ETF, where US mutual fund managers are beginning to launch their own ETFs, but these are not passive ETFs. These are effectively a listed mutual fund, but it is an open ended trading vehicle for that manager. Now, we know investment trusts here in the UK are closed ended. The big differentiation historically between the investment trusts and the ETFs listed in the UK, for example, has been that one's active, one's passive, one's open ended, one's closed ended. If you start to see active ETFs being launched in Europe, does that pose something of a challenge to the investment trust as a structure, particularly because some of these new ETFs are a bit cheaper than their predecessors?
They can be. I think ETFs certainly have their uses. At the moment, they're primarily used for taking very direct and immediate exposure to an index or a theme within a broader investment approach. And while this has many benefits for investors, there are many tools that investment trust managers have at their disposal that ETFs may not, which could nullify the threat a little bit. These include gearing. So an investment trust manager can borrow money from a number of different sources and use that to invest more than the actual pool of capital he's got. If markets go up over the long term, as we all expect, that can enhance returns, something that is not possible for an ETF. There is also the concept of the board that we talked about, that they are actually acting on behalf of the shareholders, so they can encourage a change in policy, they can negotiate lower fees, they can bring in policies to help narrow the discount, etc. So that's another perk for investment trusts. And then investment trusts also work quite well for more illiquid asset classes, such as infrastructure or smaller companies, due to their fixed pool of capital. And this is perhaps where ETFs could come unstuck, as they're trying to add liquidity to a naturally low liquidity asset class. So investors do want to try and leave an ETF it's quite a narrow exit door. And if they all pile out at the same time, that manager has still got to redeem those shares, and then they've got to go and sell sort of illiquid assets into a market quite quickly, which could very easily get difficulties. So I think ETFs and sort of those smarter active ETFs are more of a threat for the open-ended funds. Their perks are that they're more tradable and have a lower cost way of gaining market exposure, which perhaps sort of eats some of the lunch of the open-ended space. Whereas trusts already listed vehicles, so they've got that perk that ETFs do, and they offer benefits similar to it. Therefore, I think ultimately investment trusts, having been around for over 100 years, are there for a reason. They offer investors an awful lot in terms of all the capabilities that the managers have.
Understood. So yeah, effectively, there are still going to be a lot of different markets and assets that are going to just be better suited to the investment trust model than to the ETF model.
Absolutely, yeah.
Brilliant. Well, thank you very much indeed, Ryan, for coming on the podcast this afternoon. And just by way of closing, if anyone wants to find out a little bit more about Kepler and about the research you provide for investors, where can they go to find out?
Yeah, absolutely. They can just go to our website, which is trustintelligence.co.uk, or just search for Kepler Trust Intelligence on most available sites, and it'll take you to there.
Fantastic. Well, thanks very much indeed for your time today.
No problem. Thank you very much for having me on.
You've been listening to the Armchair Trader podcast. Make sure you visit our website, www.thearmchairtrader.com, for your daily dose of financial markets news and sign up to our free newsletter there.